In the first half of 2022, you also had the Treasury refilling their cash account. So the Treasury has a big cash account with the Fed. And when they fill that up, they're basically pulling liquidity out of the system. And when they draw it down, they're pushing liquidity back into the system. Basically, they want to maintain about a $500 billion in their what is essentially a checking account. And part of the reason why the first half of 2022 was so bad for asset prices is because the Fed was no longer doing QE and the Treasury was aggressively filling up its account, and therefore you had a really bad environment for liquidity.
Hey guys, welcome back to Everyday Finance. In this video, Lyn Alden discuss about market. Lyn Alden says the M2 money supply and the Fed balance sheet were all declining, which is where we observed the negative performance. Is this a correlation between, say, market liquidity and asset prices? Yes, there is a significant correlation over a 3 to 9 month period, at least for major asset classes. Some stocks may still perform well or poorly based on their fundamentals, but overall, risk assets' performance largely depends on liquidity. As a result, we will essentially be testing the system's ability to maintain tight policy even as we experience a record-breaking amount of liquidity. And lots of things Lyn Alden discuss, so please watch the video to end and share, subscribe our channel Everyday Finance. Thanks.
So I think it depends on the time frame. I think in the near term, liquidity conditions are a key driver. So that's something to watch. We'll probably talk about that a little bit more. Basically, dynamics between the Treasury and the Fed, and whether or not cash is being sucked out of bank reserves or not. So I think that's a big variable. Beyond that, kind of longer term, more structurally, the U.S. fiscal deficits are a big variable because they're very large, both in absolute terms and as a percentage of GDP. And that is basically a background inflationary stimulatory force. And of course, it's offset by other things, Fed tightening, trying to restrain the private sector. But you have these kind of two really big forces pushing back on each other, which is different than some prior recessions that we've had. And probably another big variable has to be China. Basically, right now, China's, they're reopening, their overall kind of coming out of their lockdowns has been kind of mild. They've had slow economic growth, and this affects things ranging from commodities to just overall global business conditions because they rival the U.S. in terms of economic size. Yeah, so this is something I've been tracking for a while, and for the past 6+ months, it's been a very mild scenario. It's been constructive, and the problem is that now it might turn more rocky. And so basically, the Federal Reserve is for the most part removing liquidity from the system. They're doing quantitative tightening. They had to briefly add liquidity to the system after the bank issues in March. So they've kind of been liquidity flat, but in general, they're still doing quantitative tightening. So they're still a net liquidity subtractor. And in the first half of 2022, you also had the Treasury refilling their cash account. So the Treasury has a big cash account with the Fed. And when they fill that up, they're basically pulling liquidity out of the system. And when they draw it down, they're pushing liquidity back into the system. Basically, they want to maintain about a $500 billion in their what is essentially a checking account. And part of the reason why the first half of 2022 was so bad for asset prices is because the Fed was no longer doing QE and the Treasury was aggressively filling up its account, and therefore you had a really bad environment for liquidity. In the second, around autumn, you started to see the Treasury cash account draw down because they were overfilled. So they were pushing cash back into the market. And so even though the Fed was doing quantitative tightening, it was being offset by the Treasury. So you went from, really bad liquidity conditions to flat liquidity, which is also when the stock market bottomed and when the dollar index peaked, all in that kind of late September period last year. And then they ran into the debt ceiling. So instead of just drawing down to their normal cash target, they had to draw down to roughly zero over several months. And so from that period, kind of the last quarter of last year, all the way up until this debt ceiling resolution in early June, you had the Treasury offsetting the Fed. They're pushing all their cash, literally all of it, into the market, and so you had flat liquidity conditions, which was constructive, at least not terrible for a number of risk assets. Obviously, tech and things like Bitcoin, they did the best. Other areas were kind of more flat in general, but you didn't have that really negative asset period like you had in the first half of 2022. And the problem is that going forward, now that the debt ceiling has been resolved, the Treasury is once again going to refill its cash balance. So the Fed's doing quantitative tightening, and the Treasury is going to refill its cash balance. So this is potentially resuming a negative liquidity trend. It's not materialized yet, but it's something that is now on the horizon for later this month and then the months that follow. And the challenging part is to see how that's going to affect markets. So we can't be sure how it's going to affect markets, but what we can kind of be sure of is that it's a more uncertain liquidity scenario going forward than it has been over the past, say, 6 to 9 months. And I think the biggest question is, can they get that liquidity to come out of the reverse repos, or is that going to come out of banks? Because if it comes out of banks, that's when we probably have a problem.
How does that work?
So that's a big correlation to any kind of given 3, 6, 9-month period, right? So liquidity really drives a lot of asset prices, at least for major asset classes. Some stocks and will still do great or do poorly based on their fundamentals. But in general, whether risk assets are doing well or poorly, in large part depends on liquidity. And basically we're kind of going to get a test in the system for how tight can the Fed be when we're getting basically a record deluge of new Treasury issuance, right? So when the Treasury was drawing down, it was easy for the Fed to be tight because they were being offset. But now if they're both being tight, you could get something to break, or they could try to figure out how to get out of reverse repos, but that's harder to do. Yeah, so I think you have to look at a couple of things. One is just general S&P indices. They tend to track liquidity pretty closely, not necessarily on a week-to-week basis, but like on a month-to-month, quarter-to-quarter basis. That's a big factor. It's not the only factor, but it's a big one. Another one you want to look at probably is bond market liquidity, so Treasury market liquidity. During the when the stock market bottomed, and the dollar index peaked last year. If you looked at what was happening in the Treasury market, it was kind of ugly. So not just the yields and the performance of things like TLT, but it was also the liquidity and the volatility. So the MOVE index was extremely high. Liquidity was very poor, right? So there were, auctions were weak. There were tailing auctions. And so, as the Treasury started, drawing down its cash balance, that largely fixed itself. And then the question is, now that we go into another period of Treasury's offsetting liquidity, Fed's offsetting liquidity, you probably want to pay attention to the health of the Treasury market in addition to just asset prices in general. So yeah, my honest thought is it's very uncertain because, and that was not my thought 6 months ago. So 6 months ago, I was like, there's actually a lot of clarity here. Until the debt ceiling is resolved, the Treasury is going to offset the Fed. And so, you always get curveballs, like, for example, some of the bank collapses, but the general asset prices and liquidity profile were pretty straightforward to map out until you got to certain points. So now I'm basically reporting that that's not the case, that I have very little certainty about the next 3-6 months because it kind of comes down to human decisions. What is Jerome Powell going to do? What is Secretary Yellen going to do? Are they going to fulfill the TGA as fast as they say they are? Kind of like how the Fed's forward interest rate forecasts are not necessarily what they end up doing. The Treasury's own forecasts for what they're going to do with their cash balance are not always accurate. And so there's actually no way to fully predict what these small number of humans are going to do. Then there's the big question of whether or not it's going to come out of reverse repos or not. And I think that's going to be challenging to do. I think some of it will come out of reverse repos. The other big area that liquidity still is available is in large banks. So small banks are really tight on liquidity now, but say the big 4 or the big 7 banks, they still have liquidity that this can come out of without really affecting markets too much. So we're kind of at this unusually uncertain period. And so my general advice is just basically be prepared for a wide range of outcomes, which for different investors means different things. For some means it means degrossing, not being leveraged, not taking high conviction directional bets at this time. Make sure you have a watch list. If we do get, disorderly markets, there might be things you want to buy. Be careful about over exuberance on certain stocks. So it's not that I'm like a doomy outlook, but I do have a cautious outlook until there's more clarity about what's going to happen with liquidity, or until there's some sort of breakage and reversal.